Good afternoon, everybody. This is Matt Steinholtz with Tobias Financial Advisors. We have a couple more people logging on with us right now. We will give them a minute or two, and we'll be right back to start our presentation. Hi, good afternoon. Welcome. My name is Matt Steinholtz. I am the President and Chief Investment Officer here at Tobias Financial Advisors. Welcome to our second quarter 2019 market update webinar. Today we will be discussing where we've been in the economy, what the markets have been doing for the first part of the year, and a few other items. But before we really dive into the presentation, I would like to remind everybody that this is for general information only. Your facts and our listeners' facts and circumstances are going to be different and unique. So, today's presentation will be a higher level learning about the markets and the economy. And any information I say today, we really need to reach out to your Tobias Financial Advisor and to discuss your personal situation. And another housekeeping tip here before we get too far into the program, we have on the webinar technology a question and answer field. If you do have a question as we're going through the presentation today, please feel free to put a question into the webinar system, and we will try to get to your questions as best we can at the end of today's material. Quick reminder, Tobias Financial Advisors, we're based here in Plantation, Florida. We were founded in 1980. We have over $375 million under our investment management, and that is mostly for personal clients, personal financial plannings, but we do work with some corporations with their retirement plans as well. Between ourselves and our founder and our advisors here, we have over 75 years of cumulative experience, and I have a chartered financial analyst, a CFA. We also have advisors with CPA designation, and more importantly, for certified financial planners. Most of our advisors are required to have a certified financial planner. So we have a lot of education, and we look forward and we really enjoy working with all of our clients. Broadly speaking, what is our strategy? Well, we try to break it down into a few major points as to the high-level strategy that we put out for our clients. And it's really just about being able to control what we can control. There are many things in the world, the economy, the markets, that it's kind of like the weather. You really can't control it. You do your best to maintain it and bring an umbrella if it's going to rain. It's much like our financial planning. We try to control what we can control. Obviously, we can't control if it's going to rain or not, but we do a lot of high-level recommendations and analysis to make sure we're doing our best to put our odds and probabilities in our favor. And generally, what does that mean? We create an investment plan with our clients to define how we're going to invest based upon the client's circumstances and unique characteristics. We structure the portfolio on different return metrics, whether that be stocks, funds versus bond funds. It could be value stocks versus growth stocks, emerging markets versus international markets. We want to pick the drivers of returns that are most efficient and are most reliable and most productive in the portfolio. We want to diversify broadly. We want to reduce our expenses. We are really cognizant of all the investment expenses that we have in the portfolio, whether that be trading costs or what the fund managers charge to do their investment management. So that's something we can control, as well as taxes. And we'll dive into that maybe a little bit more down the road. But there's all different types of accounts. Roth accounts, IRA accounts, taxable trusts, taxable joint accounts. So we want to really think about what kind of investments we're putting into each of those buckets to help our clients achieve their goals. So today's agenda, we are going to take a trip around the world as far as market performance in the last 6 months to a year. We're also going to be talking about some of the topics and themes we're seeing in the markets, as well as some of the topics and themes our clients are asking us directly. And then I said at the end, we're going to probably save some time for Q&A as well. So the second quarter, it was a positive quarter in the U.S. markets. You can see on our slide here, we have all green arrows, which green is good. We like to see that. The U.S. market, international, developed markets, both came in at right around 4% for the quarter, second quarter of 2019. Now, that wasn't a smooth ride. We had May, I think it was May 3rd or May 4th, where we first started hearing about the rippling of the trade talks between China and the U.S. and how that was kind of starting to break down a little bit. And that from that point in May, we had some pullback in the stock markets. And then in June, it kind of came back. So it wasn't a smooth ride, but it was definitely a positive quarter. You can see in the emerging market world, where China is a major player in those markets. When we talk about emerging markets, it wasn't as productive as the other markets. It was only up less than 1%. U.S. bonds and global bonds were up 3%, and that's basically a function of lower interest rates and lower interest rates expectations that have gripped the market in the past 6 months, and that trend continued in the second half, where the U.S. bond market, which stretches from very low and short maturity or more short maturity bonds, maybe 3 to 6 month bonds, all the way out to 30 bonds. This is a composite of a positive 3%. So we had a really good quarter as far as equity and bond markets. We don't always see that. A lot of the times the bond markets will be inverse to the stock markets and vice versa. And I'll describe a little bit more as we go into our presentation today, so maybe some of the reasons why that occurred. So moving on, we want to take a look at the last 12 months. And I want to say congratulations to all our listeners today that didn't react in the fourth quarter and stayed to their investment strategy. As you can tell, looking at this graph, it's kind of V-shaped. It was a tale of two different 6 months. The end of the 2018 period versus the beginning of 2019 is starkly different in returns. And sticking to your investment portfolio and not reacting was the name of the game over this time period. And we had, at the end of last year, we had a lot of some bad news in the market. I wouldn't say necessarily bad news, but we had some dislocations where the financial markets took a turn. We had the prospects for really low interest rates in the U.S., increasing interest rates in the U.S. happening towards the end of last year. And then literally the first week of January, Federal Chairman Powell in the U.S. came out and said we're not going to raise rates as quickly as we might have indicated previously, and they've kind of put it on a pause. And now the markets have, fast forward 6 months, coming up here on the meeting at the end of July with our Federal Reserve, most indicate that we're going to have a rate cut in the interest rates. And that has put a lot of people and the economy and the markets at ease, thinking that the Fed is committed to keeping this long-term economic growth continuing for a couple more years. So that's been really welcome news in the economy. We'll see what happens at the end of July here as to what magnitude of interest rates are cut, whether it be a quarter interest rate point or half an interest rate point cut, and they'll be also probably giving guidance for later on in the year as to what's been happening in the economy. So overall, it was a bit of a bumpy ride. At the end of last year, we almost made it to an official bear market, meaning a 20% drop in the U.S. markets. And fast forward this year, we pretty much have a 20% increase. So let's take a look at where we're at year to date. This chart here is 24 to 2018 by year. So I call this the quilt chart. These look like quilt patches to me, and each color represents a different asset class. So I'll take from the column. We'll take a look at 2018, as I've been mentioning how stark of a difference it has been. So if you take your eyes to the 2018 column, and you can see that cash was the best performing asset class there at 1.8% return. And you scroll down your eyes and you see the different colors, which each represents a different bucket of an asset class of what we can invest in. We had stocks, emerging market stocks, -14%, international developed stocks, -13%. And a combination, a more balanced approach there showed for the year of 2018, a -5.8% return. So fast, kind of flip your eyes over then to the next column over. 6 months in, year to date, we are looking at the green square there. That's U.S. large companies at over 18%, U.S. small companies at 17% in the orange, and international 14.5% return. So again, just a stark difference between what we've seen and what we've seen going forward here. A balanced portfolio year to date, depending on how you were invested. This is a representation by J.P. Morgan of a balanced portfolio and different weights. So this is, might not necessarily be your exact weighting, but a balanced portfolio did somewhere around 12% with no investment management fees and no investment management fees or underlying investment management fees from portfolio managers. So that was on an average portfolio. So we're really excited to see that. And just to go along the lines of a diversified approach, if we just pick a color, let's pick orange. For 2005, orange was below kind of the average line that's drawn through here. And 2005 is below, 2010 it was above, 2015 is below, 2016 is above. This chart, it's one of my favorites. It really tells the story and the picture of why we want to stay invested in a diversified portfolio. So what clients are asking? We've been hearing a lot of, how should I be invested during retirement? We've been hearing a lot about, the markets are higher, or they've had a good year. Should we be putting money to work right now? Should we be thinking about slowing, doing something different just because the clock struck midnight on our birthday and now we're 65? Should we really be doing something different with our portfolio? So I want to kind of break it down maybe a little bit differently today with 3 buckets that we're going to be discussing, kind of a legacy, wants, and needs. And this is going to be different for each person, as I mentioned before. Your situations are going to be different than your neighbors. This situation is going to be different than your kids. But when we're building up a portfolio, basic needs, obviously at the bottom of the triangle, these are expenses and our desires that we have to have. It's just there's no other way. We need shelter, we need food. This needs triangle is something that we want to fulfill with income streams, maybe as your Social Security, as your pension, or when we talk about a portfolio mechanics or portfolio construction, this is mostly the safer part of the portfolio when we're thinking about retirees. When we're thinking about retirees, this is your high quality bonds. This is bond funds. So bond funds, in our perspective, are there for a couple reasons. One, they are kind of our shield during tough times in the economy and the markets when the stock market might not be performing as what we'd like and the stock market's going down. We put up our shield in the form of fixed income, and that acts as our safety net, as our bucket of funds where we know that even if the markets do go down, we have this high quality bucket of investments that we're able to pull from in a down economy or a down market. So and we have all types of fixed income funds. We have kind of at the kind of the front end of the curve, the yield curve. We have really short-term money market funds. We have government bond funds. We have corporate bond funds. We have all mortgage-backed bonds. We have all different types of bond funds. But the gist is that for your needs part of the portfolio, we want to be protective and we want to use our more reliable and generally safe funds to make sure we have enough for your needs. And just as a side note, back in 2008, for our retiree clients, we typically, for everybody that went through that time period, and it's amazing, we still talk about that time period, just how dramatic it was for everyone that lived through it. But particularly for retirees, we typically keep enough of assets into their bonds, their fixed income allocation, that even when we have these drastic moves like we saw in 2008, we didn't have to go out and sell their stock funds and take losses. We were able to fund their retirement living, their retirement needs through their fixed income component. And so it was really powerful, and it's time tested to kind of build that layer of protection to combat and fulfill your needs. So the next kind of step up on the triangle is wants. Obviously everyone's wants are different, but these type of portfolio blocks that we can use here are equities, which is another word for stock funds, and different maybe deeper quality or lower quality bond funds might be an opportunity here. But these are the growth component of your portfolio. This might be higher quality stocks that pay dividends, blue chips, where we're looking to not truly speculative and not be high growth stocks, but nice stock funds that target maybe value, maybe dividend payers, maybe quality stocks. This bucket here needs to grow as well, and that's why we kind of invest into the more developed funds, developed international funds, high quality stock funds. And then finally, the legacy. What does it mean? Now that my needs are taken care of and my wants, whatever that might be, an extra vacation's taken care of. Maybe it's I want to leave a legacy for my kids or for a charity that I really feel fond. And how are we going to grow your portfolio from that part of the bucket into the future? And again, it's mostly composed of having a long-term horizon for stock funds and having a long-term horizon for being able to have the ebbs and flows of the markets and being able to know that these other parts of your life are covered and that we're able to invest more. We have a lot of clients, we say intergenerational planning. It really just means working with our clients' families, starting from the hierarchy of the grandparents who, they pretty much have their needs and wants covered, and now they're thinking about the next generation. So, and when I get to the point about the age, there's a couple points I'd like to make about that. So, age 65, we still, with an average life expectancy at, say, even 90, and maybe even closer to 100, depending on what the planning age and your health and heredity, genetics, we might be needing that money, this portfolio, to last you another 30 plus years. So we want to think about when we build these portfolios, it's not just because you're retired now, we should get really conservative. We want to have the growth to meet your wants and your needs and growing into the future. So we don't manage our assets to retirement. We want to manage them through retirement and make sure that we're fully invested. And the other point about age is we have some clients who are in their 80s that have a relatively aggressive portfolio. And the reason why is because they're able, through other income sources, maybe a pension, Social Security, real estate investments, whatever it might be, or they just have a larger portfolio that they have all their needs figured out, that they're able and willing to invest a little more aggressively in this legacy bucket and might be willing to go a little bit more aggressive on the equity side. So, it really comes down to your personal situation. It's not about age. It's not about, what kind of job you have in life, or it's really about using the portfolio to achieve your goals. And I think that's really what we do here at Tobias Financial Advisors, is help you build a portfolio that's going to help you achieve your dreams. So that was just kind of a little bit about portfolio construction and how we think about building the portfolio. So another common thread that, no one likes volatility in the markets. No one likes to see negative 250 points on the Dow or plus or minus 2% types of moves. So this chart here, if I can explain it to you for one moment, dates back to 2001, and the pink bar charts there, the pink bars, represents the amount of days where we had a plus or a minus 2% move in the market. 2008, the highest pink bar, 72 days that year, we saw a plus or minus 2%. That was volatility. We got lulled into a sense of low volatility the last few years. In fact, in 2017, we had a time period where there was actually 310 trading days without a 2% move, plus or minus. So it's really been smooth sailing, and then the volatility came back in 2018. But so far this year, we're under the average. We're at 4 year to date. The annual average is at 11. So if we took 4 times 2, since we're halfway through the year, we're at 8. If we're staying on the same trajectory, we would still be underneath that 11-day average since 1950 of plus or minus 2 trades. So it's been, I wouldn't call it a smooth ride, as I noted earlier. We've had some ups and downs, but it's just not maybe spikes and valleys. It's been 1% here, 1% down, 1% up. But so I guess the point of this slide is that volatility is a normal thing. When we do have it either on the upside or the downside, we need to always take a deep breath and realize that the markets do zig and zag, and there's typically no straight line in investing, and we have to be ready to sustain some volatility. Another client question we get a lot is, well, what about international stocks? Why do I need international stocks when it seems that the constant talk of tariffs and the U.S. economy is doing well, and we've had this long period of economic stability and growth? And why even bother with the international stocks? And we found some data from Morningstar that, based from 1970 up through June 2019, when we were looking at 10-year rolling periods of returns, when we do the math, look at it, that only 52% of the time that the U.S. stock markets outperform international markets. So it's not quite a flip of the coin, but you can see how clearly you'd want some international exposure in your portfolio. Additionally, when we look at the world market capitalization, what you can invest in, about half the stocks are in the U.S. and half the stocks are abroad. If you turn an eye to investing globally, you would have missing out on 50% of the stock markets or stock and equities around the world that you could be invested in. And even looking further and deeper into this slide, we've had a good year in the U.S. markets. We've had ultimately good returns for the past 10 years. It's been pretty much a record as far as what the U.S. stock market has done. So what happens when the U.S. stock market doesn't do so well? Well, when the U.S. stock market returns less than 6%, 94% of those time periods, the international did better. And then when the U.S. stock market did less than 4%, 100% of the time, the international part of the portfolio would have done better. So really, we want to just make sure that we're owning the global markets and not being too focused on the U.S. And, talking about valuations for a moment and where we're seeing out there as far as kind of where to put your money or where to think about putting your money. The U.S. has done remarkably well. The valuations of how we think stocks are priced, if a market's on sale or not, typically we look at the price to earnings ratio. And the U.S. price to earnings ratio is in line historically to historical average, maybe a little bit higher depending on which metrics you're looking at. But compared to international markets, the international markets still look to be attractive. From a valuation standpoint, they do look a better value, or they seem to be on sale more than the U.S. And we're starting to kind of see that as well. The U.S. did very well in the first 6 months of the year, but European stocks actually had the best first half of their years in the past 21 years. So European stocks have also done well, and they're starting to kind of come out from under their shell a little bit, and we're starting to see positive returns abroad. So what can we expect? How do we think about the portfolios, and what should we expect going forward the back part of the year? First and foremost, we're going to keep hearing about trade. Not getting political, but we're getting into election season. The Democrats have already started their primary debates and who's going to represent the Democrats here in the United States. UK, the Brexit is currently, as we speak, trying to figure out who's going to lead them next, and I think we should have an answer soon on that front. But that's Brexit. That's dealing with the EU, how that's going to play in between those economies. So we have some tensions, and I don't think that they're going to be going away anytime soon. So whether it be we find a truce with China or a new NAFTA type of agreement between the U.S., Canada, and Mexico, this is all being negotiated, and I think that we're going to continue to see that as we head into the elections. Are tariffs the worst thing in the world? They're not great. They're typically a lag on the economy, but from an investing standpoint, it's oftentimes hard to decipher how they're going to affect different industries. When you see a headline about a tariff that's happening, there's going to be winners and losers. There might be some industries that benefit from tariffs, and we find that they have maybe more domestic demand, or maybe internationally, what China was servicing a country by exporting goods there. Well, maybe Vietnam or another Asian company might step in and fulfill those orders. So what I'm trying to get at is that it's very hard to kind of distinguish on who's going to be winners and losers over the long term with the tariff talk. So I don't tend to get overly excited when there's a new tariff threatened. I view them as a lot of negotiation tactics to really kind of drive trade deals. So I think that's going to be here to stay for a little bit, but not necessarily being a tremendous drag on the U.S. economy and the global economy at large. The U.S. economic growth, I think we're going to continue to be stable. We might see a little bit of a slowdown in the second half, but with the Federal Reserve showing that they might be lowering interest rates, that should act as kind of a smooth landing or kind of continue to see U.S. growth continue. Unemployment's still one of the lowest ever. It's going to be interesting if the Fed does cut rates here in July. I believe it'll be the first time that they've cut rates with unemployment under 4%. So, we're still at really good economic levels here. And, recession might be coming, but I don't see it to be imminent. And we can debate how deep of a recession it might be when the U.S. is growing at 2 to 3%. I'm not. We're gonna have to wait to see how the data comes out in the next 6 months as far as where we see there might or may not be a recession. I think that's going to continue to have. U.S. is going to have continued growth. It just might be a little bit slower, but it's still growth, and we'll take that. What's going to be really important also to think about is, we've hit it on it a couple times today, is broad diversification. When we looked at that quilt chart where we saw the different asset classes moving in different directions, we also want to continue to practice it. It's almost really more important in the late stages potentially of an economic cycle where different economies and different countries are going to be moving at different paces. And so we really think that we did have a good first half of the year. It's not always a good second half, but we want to be smart about our global diversification and take some profits off the table where it might be prudent in our portfolios. So we do have a couple questions rolling in from the audience. I'd like to address one here. It revolves around, if the Fed is not going to increase interest rates, perhaps decrease interest rates, where can I find a good place to put my money for that conservative part of the portfolio, that fixed income part of the portfolio, and what about cash? Okay, well, we got a couple of answers there. So where should we put the assets? So if rates are going lower, investments that are going to continue to pay a decent yield would be a good spot. Maybe it's a preferred stock fund. Maybe it is a high yield bond fund, which is another name for lower credit bonds. We're going to have to be careful if you're using that in your portfolio to really watch. Just as fast as rates went down between the last year or so, they could easily turn around if we start seeing some good positive economic data. So we want to be careful there. Cash is not always king in times like these. If the rates do go lower, which spurs inflation. Remember, the Federal Reserve has two different kind of mandates. They have a mandate to keep the economy moving, and they want to promote inflation in the economy. Not ultra hyperinflation like you see elsewhere in the world, but you want some steady inflation, and that's one of their jobs. So if they do lower interest rates and this creates an inflation level, cash is not going to be the place to be. Cash will not keep up with inflation during this time period. So we really want to be wary of keeping too much of your portfolio in cash, especially in a lowering rate environment, because if you're not keeping up with inflation, then you're losing purchasing power. And losing purchasing power is detrimental to your future long-term success. So it's something to keep an eye on. There's a couple different routes to combat lower interest rates and still find some yield or some interest out there in the portfolio. But we just want to be careful of how much we're keeping in the cash and on sidelines. And with that, I don't see too many other questions rolling in, so I would like to say thank you for joining us today. Please speak to your advisor here at Tobias Financial Advisors or directly to me if you'd like to have any questions or follow-ups from this presentation. And also, we love to hear any feedback from these events. So if you do have any comments or questions, please let us know about that as well. We wish you a great rest of the summer. Stay cool and farewell. Take care.